In November 2022, Elon Musk lost $200 billion. Not over a year, not over a decade. Over the course of about 12 months, his net worth dropped by more than the GDP of Portugal. Reporters called it the largest destruction of personal wealth in human history. And somewhere, you probably read that headline, paused, felt something. Maybe it was satisfaction, maybe it was confusion, and then asked a question that almost nobody actually answered. Where did the money go? Like physically, where is it? Did someone get it? Is it in a vault somewhere? Did it just evaporate? Because here's the thing, when a billionaire loses $100 billion in a day, there is no vault, there is no transfer. Nobody got richer in the exact same moment he got poorer. The money was never really there to begin with. And once you understand what that means, you'll never look at wealth or the news the same way again. Let's back up. When we say Elon Musk is worth $200 billion, or Mark Zuckerberg is worth $180 billion, or any billionaire is worth any number with 9 zeros, we're not talking about cash. We're talking about paper value. Here's how it actually works. Most billionaires have the overwhelming majority of their wealth tied up in stock, shares of the companies they founded or run or own a significant piece of. Musk's wealth is mostly Tesla stock. Zuckerberg's is Meta, Jeff Bezos, Amazon. Now, stock has a price. That price changes every second the market is open. And when you multiply the number of shares someone owns by the current price per share, you get their net worth. Simple enough. But here's where it gets interesting. That number is not money. It's a valuation. It's what the market says those shares are worth right now in this moment if you tried to sell them all at once, which, by the way, they never do and couldn't. So when a billionaire loses $50 billion in a single trading day, what's actually happening is this. The stock price dropped. That's it. The number changed. And because the number changed, a different, smaller number got attached to their name on a Bloomberg wealth tracker. No cash moved, no wire transfer, no heist. Just a number getting smaller. But that raises the next question. Why does the stock price drop? And when it does, where does that value go? Let's use a clean example. Say a company has 10 million shares outstanding. Each share is trading at $100. The market cap, the total value of the company, is $1 billion. Now the CEO says something that spooks investors. Maybe earnings disappoint, maybe there's a scandal, maybe the Fed raises interest rates and suddenly investors want out of growth stocks. Doesn't matter. People start selling. When more people want to sell than buy, the price drops. By end of day, shares are trading at $80. The market cap is now $800 million. $200 million just vanished. Except it didn't go anywhere. It ceased to exist. This is the part that breaks people's brains. In a stock market decline, wealth doesn't transfer from one person to another. It simply ceases to be. Now, there are exceptions. Traders who shorted the stock, meaning they bet it would go down, they made money when it fell. They were on the right side of the trade. So yes, in those cases, someone's loss is someone else's gain. But in the broad, sweeping headlines on the front page sense, when Tesla drops 15% in a day and Elon Musk loses $20 billion, nobody got that $20 billion. It existed only as long as enough people agreed it existed. And then they stopped agreeing. Wealth at that scale is essentially a collective hallucination, one that works perfectly well, until it doesn't. Here's where it starts to get a little absurd. Elon Musk owns roughly 13% of Tesla. At Tesla's peak in late 2021, the stock was trading at around $400 a share. His stake was worth something close to $230 billion. By the end of 2022, Tesla had fallen nearly 70%. His stake, same shares, same percentage, was worth around $60 billion. He lost, on paper, roughly $170 billion. And yet, he still owned the same shares, not one fewer than he started with. His actual ownership of the company didn't change by a single decimal point. What changed was the price the market was willing to pay. Now think about what it means to have $230 billion. Could he have spent it? Could he have wired it to a bank account and bought things? Not really. Not all of it. Not even close. If he tried to sell $170 billion worth of Tesla stock all at once, the act of selling would collapse the price. The moment the market knew that much supply was coming, demand would evaporate, the price would crater, and he'd end up with a fraction of what he thought he was getting. It's like owning every ticket to a concert. On paper, you own $1 million worth of tickets, but if you try to sell all of them at once, you flood the market, prices crash, and suddenly you have a stack of paper worth much less than you thought. Billionaire wealth is, structurally, untouchable at the scale the headlines suggest, which is interesting, because the headlines never mention that part. There's a version of this story that people love to tell. The billionaire lost $20 billion in a day. The workers are still getting paid minimum wage. The system is broken. And look, maybe the system is broken. That's a legitimate conversation. But the framing of that story treats paper losses as real losses, and it treats paper gains as real gains. The truth is messier.
When Musk's net worth hit $300 billion, he didn't have $300 billion. He had assets that the market in that specific moment of peak Tesla euphoria was pricing at $300 billion. If he tried to access even 10% of that as cash, markets would have moved, prices would have shifted, and the number would have already changed by the time the transactions cleared. The same logic applies on the way down. The headline, Musk loses $200 billion, is emotionally satisfying but technically incoherent. He lost $200 billion in the same way he had $300 billion, which is to say on a spreadsheet under specific market conditions with enormous asterisks attached. This doesn't mean billionaire wealth is fake in the sense that it has no tower. It absolutely does. You can borrow against stock, you can use it as leverage, you can fund rockets with it. But it's not money in the way the rest of us experience money. When your bank account drops by $1,000, that $1,000 is gone. Someone has it. You don't. When a billionaire's net worth drops by $100 billion, almost certainly nobody has it. That asymmetry is worth sitting with. Now, let's zoom all the way out, because this isn't just a story about billionaires. This is a story about how modern financial systems are built. Trillions of dollars of global wealth exist only in the form of asset prices. Stocks, real estate, bonds, derivatives, none of it is cash. All of it is contingent on what someone else is willing to pay for it at any given moment. In 2008, the housing market didn't crash because money physically disappeared. It crashed because the assumptions underlying the prices collapsed. People had been buying and selling mortgages as if they were safe, low-risk assets. When it became clear they weren't, the prices attached to those assets collapsed, and roughly $11 trillion of American household wealth evaporated. Not stolen, not transferred, evaporated. The global financial system is at its core a machine for assigning prices to things, and those prices are only real as long as people believe in them collectively. The moment belief falters, the prices fall. Which is why central banks and governments intervene so aggressively when markets crash. It's not just about money, it's about maintaining the shared fiction that makes the whole system function. That's not cynical, that's just how it works. Even the dollar in your wallet is, in a technical sense, only worth what it's worth because enough people agree it is. The difference is just that billions of people agreeing about the dollar creates a very stable kind of fiction. A handful of traders disagreeing about Tesla creates a very unstable one. So the next time you see a headline that says a billionaire lost $30 billion in a single afternoon, remember what you're actually reading. A number changed. A market reconsidered. A valuation adjusted. Nobody got $30 billion. The money didn't flow somewhere more useful. It didn't fund hospitals or schools or go back into some cosmic account. It just stopped being agreed upon. And somewhere in that fact is something quietly important. Not just about billionaires, but about what we call wealth, what we call value, and how much of the financial world we think we understand is actually just a very sophisticated, very fragile consensus. The uncomfortable question isn't where the money went. The uncomfortable question is whether it was ever really there.